Risk. FTX and their charismatic leader Sam Bankman-Fried, or SBF for short, was worth $34 billion last week at this time and filed for Chapter 11 bankruptcy on Friday. They must have had some risk, huh? The unravel of what is there and what is lost will take months and months. Meanwhile, those traders who have their money at the exchange don't have access to their money at that exchange. The rumblings are that the customers had $16 billion of deposit at FTX, of which FTX then lent out $10 billion to its sister company, Alameda Research, a trading entity. What other liabilities, what other assets they have will all go in the pot, and I imagine something, not much, will be clawed back by traders stuck with their deposit at FTX with no access to it right now. The determinant will be on what Alameda Research owned and potentially still owns. I guess they're still at risk. And what they, FTX, spent, and that should have been customer funds. My guess is that they did not own the S&P Energy Index, which has risen 69% in 2022, but things in the crypto universe like Bitcoin, which is down 64%, or maybe Ethereum, which is down 65%, or Solana, which is down 89%. Everyone is a star in assets that encourage owning when prices are going sky high like all crypto did in 2021. You don't need to focus on risk. What risk? It's all about FOMO and HODL and reward and your individual view. Those people are very smart, much smarter than me, but not in everything. This is one of those things. When the prices of this stuff start going lower like they have in 2022, the winter of crypto, that is when risk management becomes a, well, maybe we should have thought about that thought. The CEO of Alameda was an SBF prodigy named Caroline Ellison. The 28-year-old graduate once worked with SBF at Jane Street, a self-described quantitative trading firm and liquidity provider with a unique focus on technology and collaborative problem solving. Okay, kind of makes my focus on the 100/200 bar moving average seem menial. Ellison stayed at Jane Street for 19 months before leaving. She later joined Alameda at the persuasion of SBF. After arriving at Alameda, she admitted in an FTX podcast that she had kind of more trading experience than a lot of Alameda traders. She also said that at Alameda, she found herself making a bunch of decisions, a lot of which were really uncertain, and that was terrifying. Anyway, CoinDesk revealed this week that billions of dollars worth of the FTT's token were sitting on the balance sheet of FTX's sister firm, Alameda. So in addition to risky positions in crypto, most likely, they also own the ancestral FTT tokens. So what is an FTT token? According to Lending.com, who explained in an article titled, "What is FTX token?" FTT explained in plain English, an FTX token, FTT, is a utility token that provides access to the FTX trading platform's features and services. So I guess you can think of it as the added price paid to get into a meet and greet after a rock concert. The FTT token creates utility in the FTX ecosystem by incentivizing users to hold and use the token. So it encourages you to buy more tokens and trade more, and that gives you discounts to trade. The FTX token was created to provide traders with a way to save on trading fees. When users pay for their trades using FTT, they are given a discount on the fees charged. The more FTT a user holds, which they buy and which FTX sells, the bigger the discount they receive. In addition, users who hold FTT can vote on new listing proposals and much more! Exclamation point. They also had a better probability to receive airdrops. Airdrops are like the free grilled chicken sandwich reward I received on my Chick-fil-A app recently. Here's a receipt. Didn't cost me anything to get the airdrop. All I had to do was use the app to place my order for pickup, which, by the way, is better than getting in line At FTX, you had to pay for the right to get airdrops. In return, you own the FTT token. So FTX had billions of dollars of risk in their own FTT token because Alameda owned them. Risky business. Enter Binance, a rival exchange, who owned $500 million or so of FTT tokens as a result of their collaborative history. They made it known earlier this week they would be selling their tokens, which FTX was propping up at $22 artificially. So think of the FTX bid in the FTT token at 22, like the Swiss National Bank bid at 120 for the Euro Swiss before pulling that peg and seeing the pair tumble as a result. This is the Euro Swiss chart. This is the FTT token chart. The dam was broken and the FTT shares moved to a low of $1.07 at its lows this week before rebounding marginally. It is still down 92%. Needless to say, FTX got well over their skis with regard to risk. Instead of being a good exchange that brings buyers and sellers together, their ego and greed and power-hungry money grab led to taking on excessive risk. They took customer money and thought they could leverage that money to more fortunes, probably because of the lie that all crypto is going to the moon. So the lesson to all of you, risk does matter. And that is what I will focus on now, like I always do in the week ahead technical Forex report, where I didn't need a mathematics degree from MIT or Stanford, but from the School of Common Sense to understand a way to define risk and a bullish or bearish bias. Ladies and gentlemen, my name is Greg Michalowski. I'm going to take a look at some of the major currency pairs from a technical perspective. Now that we've gone through a little bit of the fundamentals, just a little afterthought on the fundamentals. Last week we did see the dollar move sharply lower. Why? Because CPI data came in a little bit weaker than expectations. That weaker than expectations was one of those binary events that the market was sort of gearing up toward that allowed the dollar to move lower. We saw that stock prices move higher and we saw the yields move lower. So it was sort of a avalanche or a wave of maybe not the red wave that the Republicans were hoping for in the election week, but a wave of dollar bearishness, of markets moving, stocks moving higher, yields moving lower, that was started last week. And so with that mindset in play, let's take a look at what happened from a technical perspective. And now that the dollar sellers have come in, what do they have to do to keep that bias going from a technical perspective? So take a look at the euro versus US dollar. What is key here is our high price that we saw on Friday also stalled near the swing high prices from the month of August. Here's our high price through here. Here's our high price in August. And in addition to that, these were swing lows going back to the month of May, and these were swing lows going back to the month of June, and this is a swing low going back to the month of July. And we broke below that level right through here, retested it in the month of August, and rotated to the downside. That led to our sharp move to the downside that bottomed at the 95 level, a decade's lows for the euro versus US dollar. In trading last week, not only did we get above the 100-day moving average, but we also moved above this swing area through here and broke above this swing area and stalled at this swing area right through here, which started that move to the downside. So it was pretty orderly type of move from a technical perspective. But if it's not done, guess where we're going? We're going to the next key level, which would be our 200-day moving average. That 200-day moving average would be the next target on the break of this ceiling area, this old floor, this old ceiling level between the 103.48 and the 103.65. If we get above that level, we're going to start to look toward the 104.39 level. That's about 40 plus another 50, about 90 pips or so away, maybe a little less, 80 to 90 pips away to get to the 200-day moving average. And what's the significance of that? Well, we haven't been above the 200-day moving average going all the way back to this day in June 16th and June 17th. The last time the price traded above the 200-day moving average, well up here where the moving average was at 119.91. Where's the 200-day moving average now? 104.39. So a big, 15 big figures away from the price. The last time the price was above the 200-day moving average, seems like it would be an easy hurdle to get to and through, or at least it's easier than it was all through here because it's downward sloping. But that's what needs to happen from a technical perspective if the price is going to go higher. We need to next get above this swing area, get above the 200-day moving average, and then we'll look toward the 50% retracement. The 50% comes in at 105.15, and that's a 50% retracement of the trading range for 2022. So we've been in a trend move to the downside here. We're starting to see the corrective move to the upside, and getting to and through the 50% retracement would increase the bullish bias here. We're on our way, or it seems like we're on our way. Now can the buyers continue that corrective move and get above the 50% and start to tilt the seesaw, if you will, to the next, to the other side of the midpoint of the year? That would look toward the 106.15 and 106.34 level up here, where we have another key swing area through here. We have different swing lows and swing highs through here before the market then broke to the downside, came back up, retested that area, and rotated to the downside. So the patterns are pretty similar in what we saw over the last week with getting through swing areas, getting through technical levels. This week we have the 250% and then the swing area up here to get to and through on the downside. If we do find sellers through here, getting back below the 38.2 and taking back these levels down to 101.97 in this swing area down here to 1096 to 21, that would be, it's all in play here, folks. It all depends upon what the barometer, how the market reacts to the barometer, and the closest barometer that we have is right through this red area right here. You can see it clear as day for the euro versus US dollar. So let's pay attention to that as we start the trading week this week. Let's take a look at the dollar versus yen next. And this currency pair had one of its biggest moves to the downside that we've seen in a long time for this currency pair. Market price moved a number of big figures to the downside in the process. We fell below the 100-day moving average for that currency pair. Also fell below this swing low through here, which we tried to bottom out on Thursday's trade before bouncing off of that level, this CPI data, bouncing off that level and breaking below both the 100-day moving average and that swing area through here on our way to new lows for the new lows going back to, back here in the month of August, early September for the dollar versus yen. We'll see if the momentum can continue in the new trading week. What would keep the bias to the downside? Well, obviously staying below the 100-day moving average. That's going to be our key risk and bias defining level. As long as the price can remain below that level, it's more bearish. If we move above it, then all bets are off as far as the downside goes. The market will be looking at that level, that failure of the 100-day moving average as significant, and probably moving back higher toward the 143 perhaps level on the top side on a re-break of the 100-day moving average. But on the downside, if we were to continue that momentum, we need to get to and through the 38.2% retracement, this area through here at the 137.24 level. That area is also defined somewhat by swing highs through here, break above it, fall back below it, and then break above it through here. So right around the 137.24 level is going to be our next key barometer on the downside for the dollar versus yen to get to and through. And then if we do that, then it opens up the door and people will start talking about this key area through here. You can see that it says it starts off with D1 moving average, 2 blah, blah, blah. Then it gets hidden by the 50% retracement through here. This D1 moving average 2 blah, blah, blah is a 200-day moving average. This is a 50% retracement of the trading range from the 2022 low to the 2022 high. So big, huge trend move to the upside in the dollar versus yen. 50% retracement, which would be our target on the downside for further momentum through the 38.2. And that also corresponds with the 200-day moving average. So is that level going to be key going forward, or that area going to be key? You betcha. This area right through here is going to be a key level for the dollar versus yen. First key level on the downside, 38.2. So the bias is more negative below the 100-day moving average. Other key target levels outlined, including 38.2, 50% retracement, 200-day moving average. Let's go to the sterling versus US dollar. And what is significant in trading this last week was the break and hold above the 100-day moving average. It broke it above it on the CPI data, stayed above it on the next day, Friday's trade, and moved up to this swing area through here where we have a number of different swing lows right here where the market stalled, moved to the upside, came right back down to that area, trade above and below the level here, and then reestablish the level as resistance here before rotating to the downside. This is the truss capitulation, if you will, all the way down to 103.52 level, where the market then started to rebound back to the upside. We got above the 38.2 and the 100-day moving average and stayed above that levels on Friday, so that's positive. So we're entering into the week with a bias to the upside above this area. As long as the price can remain above this area, the buyers remain in control, and we'll look for further upside momentum for the sterling versus US dollar. On the top side, the next key target in the new trading week, we're going to look toward the 50% retracement. That level comes in around the 120.50 level. That level roughly corresponds with other swing levels through here, where we had swing low right here, swing low right here, swing highs through here, swing lows through here, before breaking to the downside. So this 50% retracement level and swing area is going to be the next key target on the top side for the sterling versus US dollar. Get above it, and we start to look toward the 200-day moving average. 200-day comes in at 122.64. If we go back in time for this currency pair, we try to break it above it here, could not sustain any momentum above that level. You have to go back to this day right here, which is September of 2021, the last time the price traded above the 200-day moving average. So keep that level in mind on further upside momentum in the sterling versus US dollar. Take a look at the dollar versus Swiss, and what do we know about it? Well, lots of volatility, and we had lots of volatility to the downside, or actually trend-like volatility to the downside in trading last week. Big, huge move to the downside. That move to the downside was, started up here where we had double tops through here, or 1, 2, 3 tops before rotating to the downside. And trading last week, we broke below the 100-day moving average on the CPI data. On Friday, we continued the momentum to the downside, falling below the 200-day moving average, which was tested right through here and bounced off of that level. So getting below that level was an open door to the downside for the dollar versus Swiss. And the next target on the downside becomes our swing lows through here and swing highs through here, where the price has a number of different swing at levels through here at near the 0.9370 level. So that would be our next key barometer on downside momentum in the new trading week. Break below this 93.70 level, and it opens up the door toward our low prices through here, including things like this low right here, these lows through here, this lows through here. All these levels will be targets on the downside and further momentum for the dollar versus Swiss. It would take a move back above this trend line right here to increase the bullish bias or to decrease the bearish bias, increase the bullish bias, and then we're looking back toward the 200-day moving average. I would expect that sellers would lean against the 200-day moving average if they're serious about this move to the downside, but understand that the dollar versus Swiss has a history in 2022 of lots of ups and downs and big moves, trend-like moves to the downside. So we can't be too sure that getting back above the 200-day moving average is something that would not happen. So we have to be aware and prepared for that. Let's take a look at the dollar versus Canada next. And on the daily chart for this currency pair, came right down to test the 100-day moving average on Friday's trade after sharp moves to the downside in trading last week. Although the dollar versus Canada was one of the least volatile of the major currencies, but nevertheless, we did move to the downside. Not only did it test the 100-day moving average, but there's a dual level right here, the 38.2% retracement. Both of them come near 132.24, and in the new trading week, we have a decision to make: either bounce off that level or break below that level. If we break below the level, we're going to come down to this trend line right here, which also corresponds roughly with these swing levels through here, between around the 130.74 to 84 area. I guess the trend line is a little bit above that level, so let's call it toward the 90 level or somewhat for for the dollar versus Canada. Break below that level and we start to look toward the 200-day moving average. We last held the 200-day moving average back here in the month of August. Market remembers that. It's going to remember it again if we have another test of the 200-day moving average. So on the top side, we have this swing area up here as resistance. On the downside, move below the 100-day, move below the 38.2. Look for the trend line, look for the swing area, look for the 200-day moving average for the dollar versus Canada. Let's take a look at the Aussie versus US dollar. Again, we'll look at the daily chart here and get a view from that perspective. And like the dollar versus Canada, we came right up to test the 100-day moving average. That 100-day moving average currently comes in at 0.6702, and the price tried to move above that level and then came a little bit off that level and closed just below the level on Friday's trade. So in the new trading week, the barometer is going to be that 100-day moving average. Move above it, and we'll look toward this swing area, and then the swing area up here, and then start to look toward the 50% and the 200-day moving average. Stay below that level and get below this little swing area through here. This covers about a week or so of trading where the price stalled around this area before rotating to the downside, moving to a low. It will become another level that we need to get to and through on the downside if the price is going to move lower, and then we'll look toward maybe this area right through here around the 0.6544 level, and get below that level would open the door for further downside here. So clearly the 100-day moving average and the 38.2% retracement are going to be our close barometers in the new trading week. Move above, it's more bullish. Stay below is more bearish. Finally, let's take a look at the New Zealand versus US dollar. And if we take a look at this chart on the, let's see what the daily chart looks like here. On the daily chart, unlike the Aussie versus US dollar and the dollar versus Canada, this pair was able to get above its 100-day moving average on Friday's trade. That 100-day moving average is going to be our risk-defining level, bias-defining level in the new trading week. It comes in at 0.6022. If we are able to stay above it, it's more bullish, and we'll look toward this swing area through here. If it's more, if we break below that level, we're going to traders are going to be disappointed on the break to the upside. Start to look toward this swing area, move toward our low price that we saw that came through here on the downside for the New Zealand versus US dollar. On the top side, break above this swing area through here. You can see the number of different swing lows and highs. We're going to start to look toward the 200-day moving average, which currently comes in at 0.63225. We did the last test of it, we did find resistance sellers, which started the trend move to the downside. So it's going to be of significance. Now, we did move above it here in the month of March and April. So we have to be prepared for, potentially a breakup and a potential failure, but that's what happens in trading. We know that. We got to pay attention to those levels. So right now the buyers are making a play in the New Zealand versus US dollar. We'll see if they can continue to keep the momentum going. Before I go, it would be remiss if I didn't take a look at the S&P 500, maybe some of and the Nasdaq index, as they had big, huge moves to the upside. In the S&P index, I mentioned at the end of the video last week that if the S&P were able to get back above the 100-day moving average, my bearishness toward the stock market would turn more to bullish bias. And indeed, we saw that happen in trading on Thursday through the CPI data. We saw the price move above that 100-day moving average, and all bets were off for the downside for that index. And the price did move up to 38.2% retracement near the 3998 and also the 4,000 level on Friday before backing off a little bit. So we do have this target to get to and through at near the 4,000 level for the S&P index before I can say that, well, the buyers are still taking more control. The other level to get to and through would be the 200-day moving average that currently comes in at 4081. There's lots of traders out there who are earmarking that 200-day moving average as a key level to see if this is just a correction or this is something else into the top side. So don't be surprised if you see sellers leaning against that 200-day moving average. Again, it currently comes in at 4081. As far as the Nasdaq index goes, it too moved sharply to the upside in trading last week, but it still remains below its 100-day moving average. That 100-day moving average currently comes in at 11518.14. Getting above and staying above that level would be required to give more upside momentum back here in the month of September. September, early September. The price did try to get above that level once again and failed, and then rotated back to the downside. So getting above that level is key. We're still short of it, currently trading at 11323.33. That moving average currently comes in at 11518.14. So there you have it. A look at some of the major currency pairs and the stock market. And also a little bit talk about the FTX and the CPI data for you to start your trading week. So I hope you have good fortune in your trading. My name is Greg Michalowski. Bye-bye now.